Bienvenidas y bienvenidos al primer panel de las Jornadas Monetarias y Bancarias 2020 del Banco Central de la República Argentina. El panel, titulado El rol de la política monetaria en la pospandemia, de la teoría a la práctica, nos permitirá discutir y reflexionar sobre el papel de los bancos centrales en el presente contexto global. Expondrán aquí el profesor Marc Lavoie de las universidades de Ottawa y de la Sorbonne Paris Nord, el profesor Jan Kregel del Levy Economics Institute y el profesor Perry Merlin de la Escuela Pardee de Estudios Globales de la Universidad de Boston. Mi nombre es Germán Feldman, soy economista jefe del Banco Central y en esta actividad también va a participar Ariel Dvoskin, que es gerente principal de estudios económicos en el banco. Marc Lavoie es actualmente profesor emérito en la Universidad Sorbonne Paris Nord y profesor emérito en la Universidad de Ottawa. Es miembro de investigación en el Instituto de Investigación Macroeconómica de la Fundación Hans Böckler en Düsseldorf e investigador asociado en el Instituto Broadbent en Toronto. Ha publicado 10 libros, 80 capítulos de libros y más de 150 artículos arbitrados, principalmente sobre macroeconomía, economía monetaria y teoría del crecimiento, pero también en otros campos como la economía del deporte. Su libro con Wayne Goldley, Monetary Economics, del 2007, se considera una lectura obligada para los usuarios del modelo Stock Flow consistente. Es coeditor de 2 revistas académicas y es parte del consejo editorial de otras 10 publicaciones. So, Professor Lavoie, please, it's all yours.
Well, thank you for the invitation under those special circumstances. I've been asked to talk about the challenges for central banks. I will talk about the central bank that I know best, which is the Bank of Canada. So let me start with 3 key features of the Bank of Canada. First, there are no compulsory reserve requirements for commercial banks, which we call here chartered banks. Secondly, despite the absence of reserves and little or no open market operations, the realized overnight rate and repo rates are always equal or almost equal to the target rate set by the Bank of Canada, much better than in, say, the United States or in the Bank of England. A third very special feature of the Bank of Canada is that it can purchase normally 10 to 20% of the securities which are being issued by the federal government on the primary market on a non-competitive basis. So I believe that this is in contrast to most other countries in the world where central banks are usually prohibited from purchasing government securities directly on the primary markets. This percentage for treasury bills was increased to 40% in April. And as things seem to have got better, it was brought back to 20% in August and down to 10% in September. So from that point of view, the purchases on the primary market, we are back to where we were before the COVID crisis. Let me talk a little bit about the relationship between the Canadian monetary system and modern monetary theory, which others will be or have been talking about. I believe that Canada is perhaps the country where the main claims of modern monetary theory apply best. So what are some of those claims? Well, first, there is no financial limit to what a central government can spend. And secondly, a monetary sovereign state cannot be forced into bankruptcy. So why is it that the Bank of Canada or the Canadian monetary system fits so well with the main claims of MMT? First, it's because the bank does not intervene in foreign exchange markets. We truly have a fully flexible exchange rate. The debt of the federal government is mainly, almost exclusively in Canadian dollars, and it's held by residents at the rate of 75%. There are no institutional limits on the federal debt. There is no debt ceiling. And as I said, the Bank of Canada intervenes on the primary market. Therefore, there's no need for the debt to first be bought by financial markets, the banks, the brokers, the dealers, and so on. And finally, the guarantor of the bank must resign if he or she disagrees with the instructions that could have been given by the Minister of Finance, although usually, I mean, it only happened in the 50s or in the 60s. Let me look at the assets of the Bank of Canada since February. What we see looking at the stocks is that the Bank of Canada has bought a lot of treasury bills. It moves from 25 billions to 134 billions in July. The same with respect to long-term government bonds issued by the Canadian government. So we have this huge increase in the balance sheet of the central bank, which is also tied to a large increase in the amount of purchase and resale agreements, which are called repos. And the numbers are very large indeed. So the balance sheet of the Canadian central bank has moved up by about 4 times since February. You can notice that there's been a few purchases of provincial bonds. So the law, the Bank of Canada law is such that the Bank of Canada can also buy provincial bonds. What are the counterparts to the repos mentioned here? Well, they correspond to what would have been done in standard quantitative easing operation, in the sense that they mostly consist of asset-backed commercial papers, but mostly corporate securities and a certain amount of securities issued by provincial government. Let's look now at the liability side of the Bank of Canada, and that's, from my point of view, I find this very interesting. If we look at bank reserves, so the deposits of the direct clearers at the Bank of Canada, in February, up to February, it was only $250 million. But now the numbers are in the billions of dollars. So it's $307 billion. So there's a large amount of bank reserves. You can see that it's more than 1,000 times the amount that existed before the COVID crisis. And strangely, we also see that the deposits of the Canadian government have moved from 26 billions up to as high as 148 billions in July. So there's a lot of, if you want, excess cash in the hands of the Canadian government at the Bank of Canada. Why is this? Well, here you can see the budgetary balance of the federal government. Those are flows now in billions of dollars. You can see that initially the Canadian government was on a balanced budget, and now it is running these large deficits. But not only that, the Canadian government made a lot of loans and advances to various financial institutions and so on. And so the financial requirements are in fact much bigger than what we can see from the budgetary balance. But what is also striking is that the bonds and treasury bills which have been issued every month by the Canadian government are even larger than the financial requirements. And so the consequences of that is that there's been this large change in cash balances, plus 52 billions in April, plus 52 billions in May. And well, these correspond to what we saw in the previous slide, to the fact that there has been a very large increase in the deposits of the Canadian government at the central bank. It's as if the Canadian government wanted to make sure it would have the cash resources ready to go if needed. Here all I wanted to show was that indeed the Bank of Canada did what it claimed that it was doing, which means that they were buying about half of the new net issues of treasury bills. And with respect to the bonds, the long-term bonds, they bought even more than what was being issued, which means they pursued what one would call quantitative easing on the side of government bonds as well. What has happened to long-term rates of interest? Here we can see that before the crisis, the rate was for these long-term bonds was about 1.50%, and now they are down to 0.5%. So those purchases by the central bank have been quite efficient. On the other hand, if we're looking at corporate interest rates, looking at the spreads here, we can see that in Canada, just like in the United States, in the Euro area or in emerging markets, the fact that the central bank is able to control government rates, interest rates, doesn't mean that they are able to have such a control on corporate interest rates. The spreads have risen in Canada just like everywhere else in February, March. And well, now, as you can see, they are going back towards what they were before the crisis, the arrival of the virus. Another feature which is surprising is the difference between the settlement balances in normal times and in crisis times. In particular, if we compare to what happened in 2008. Before the 2008 subprime crisis, the amount of settlement balances was set at only $25 million. Well, of course, this seems like a large amount, but relative to the amount of payments going on every day within the Canadian financial system, it is even less than 0.1%. Over the last few years, within this corridor system, the target amount of settlement balances has been set at 10 times more, $250 million. However, what happened during the global financial crisis? Well, nothing was changed with respect to the amount of settlement balances held by the Bank of Canada until April 2009, when the floor system was put in place, which means that the target rate set by the central bank was made equal to the interest rate on deposits at the central bank. And the amount of reserves in the system was set at $3 billion. So this was a very mild version of quantitative easing. We cannot say that it was really, that there really was quantitative easing in Canada during the global financial crisis of 2008, 2009. Then the central bank decided to go back to a floor system as a response to the COVID-19 crisis. But the numbers are hugely much bigger than what they were. The current settlement balances, as I said before, are over $300 billion. This is 100 times more than in 2009, 2010. So the bank has reacted in a much stronger way to the crisis of COVID than it did before. So this is the floor system as it can be represented. The target rate set by the central bank is equal to the rate on positive balances at the Bank of Canada, and it's currently 0.25. And the bank rate, the rate at which banks could borrow from the central bank, is set at the target rate plus 25 basis points. And so usually the amount of settlement balances, the amount of reserves in the system is usually at zero or very close to zero. But right now it's $300 billion. So we are in the surplus position. Therefore, this is why the overnight rate of interest, the repo rate, the 1 month or 3 month treasury bills, their rates are all equal to that 0.25 or very close to 0.25. So this is the situation now. What about how will we ever manage to go back to normal with a balance sheet which would be of a reduced size? And here, I think that it may take a long time because, as I said, there's been lots of repo operations, but usually these repo operations in Canada are overnight or for just 1 week. But in the case of the COVID-19, the bank has engaged mainly in term repo operations that go as far as 24 months. So it may take at least 24 months to reduce that part of the balance sheet of the Bank of Canada. However, despite the fact that the balance sheet of the Bank of Canada may take a long time to get back towards normal, the bank retains control on short-term interest rates, either through the corridor system that existed before or through the floor system, which I just described. If we came to a situation where the Bank of Canada had to raise interest rates, if it thought it was desirable, it could do so even without selling its assets and without changing the size of its balance sheet or the amount of reserves in the system. All it needs to do is to raise the target rate. And in the case of the floor system, all it needs to do is raise the interest rate paid on reserves. And all the other rates, at least the short-term market rates, will follow suit. So from that point of view, I mean, if people are worried that we would need to raise interest rates, it would be easy to do. What about the fear of inflation? Usually, the theory that you can find in textbooks says that excess reserves will lead to money creation and loan creation by banks, and therefore could lead to rising inflation. And in fact, it is true that this was one of the arguments in favor of pursuing quantitative easing. You could see these arguments made by some officials at the Bank of Japan, at the Bank of England, at the European Central Bank, but less so by the officials at the Fed. However, most post-Keynesians like myself argue that the causality goes the other way. In normal times, reserves rise because money deposits and bank loans rise. It's not reserves that will cause the money supply described as M1 or M2 to rise. And the reason for this is that banks cannot lend their reserves to the non-financial sector. The reserves can only be lent to the other banks or the direct clearers in the large value transfer system in Canada. So there is nothing that the banks in aggregate can do to reduce their excess reserves. So there's as we know, after the financial crisis of 2008, the relationship between central bank money and M1 or credit aggregates broke down, and it will break down again during the COVID crisis. So there is nothing to fear about inflation from that angle. The bad side of that is that QE will not be able to do much to improve economic activity. There is nothing much to gain from QE either at that level. My belief is that in a recession crisis, there is not much that central banks can do to get the economy going besides providing liquidity to the financial markets, so to make sure that financial markets are running well. Central banks can always lower interest rates under their control or keep them low, hoping that all market rates will follow suit and hoping that this will induce the stock market to boom so as to generate consumption out of wealth, but this is about all that we can hope from the monetary side. So I would argue, as many of my colleagues on the post-Keynesian side, that the recovery is all about fiscal policy. Right now, there are huge transfer payments and loans being provided by the federal government. So indeed, the federal government has been very active. The trouble is that households, and we have seen that both in the USA and in Canada, apparently right now are saving approximately 25% of their disposable income. At least this is the measure that we get from Statistics Canada for the second quarter of 2020. So despite these large transfer payments which have been made by the federal government, the impact on consumption have not really been felt right now. And it seems to me as long as the COVID-19 virus is around, these positive effects of the transfer payments on consumption and therefore on economic activity will not be felt very strongly. So they could be felt only in the future when it becomes possible to spend all those savings which have been accumulated by the households. Here I have a table that shows what has happened from the first quarter of 2020 towards the second quarter of 2020. What is very surprising is that despite the fall in economic activity, a fall of about 10% in Canada at an annual rate, household income has gone up by about $100 billion. And this is true despite the fact that employee compensation, as you can see comparing the data of quarter one and quarter two of 2020, has gone down by $100 billion. And this is due to the fact that current transfers made, especially by the federal government, have gone up by more than $200 billion. So when you look at the disposable income of households in the second quarter of 2020, so between April and June, compared to January to February, we see that disposable income of household has gone up by 150 billion. But final consumption by households has gone down by about 150 billion. And therefore, whereas before, well, if you looking at the data in 2019, we see that the saving of households has been equal to zero. Aggregate saving by household has been zero, whereas now it's $374 billion. So there's been a huge increase in the saving of household. So I believe both because thanks to the current transfers made by the federal government, some households have much more money than they used to have before the crisis, ironically, but also because it has become very difficult to spend for various reasons. A lot of shops and so on having been closed, little access to restaurants, the incapacity of traveling abroad and so on. So what are the challenges? So this is my penultimate slide. So I have those last two slides. What are the challenges post-COVID and post-COVID, we could say? Well, right now, there is an overly high household saving rate, 25%. We still have a high unemployment rate. It used to be 13% in April. It's about 10% now, but it was less than 6% 1 year ago. We still have a very high household debt. It used to be 180% of disposable income. It's now down to about 160%. but that's because of the large government transfer payments that have raised household disposable income. If you look at the absolute amount of household debt, it has not gone down. I mean, in a way, this is not surprising. There may be a lot of companies or small and medium-sized firms that may go bankrupt. And well, one could argue that there is a much higher public debt to GDP ratio at the federal level. It's going to be 50% by the end of the year, whereas it was 34% with respect to GDP just a year ago. And of course, there's still the challenge of a transition towards a greener economy. So this is still in the books. So for all these reasons that I have mentioned, I believe that interest rates will be kept low by the Bank of Canada for quite some time. And my last slide is what about the mandate of the Bank of Canada? Every 5 years, the mandate of the Bank of Canada is being renewed, and this will be done again in May 2021. In May 2021, the Minister of Finance and the Bank of Canada will decide on what is exactly the mandate of the Bank of Canada. So we had a couple of conferences dealing with this recently, some conferences sponsored by the Bank of Canada. So what are the options? Well, first option, of course, is the status quo. Right now, the inflation target is 2%, and meaning that the inflation has to remain within a 1% to 3% band. So there's a lot of people who believe that we should keep it as is. A number of people believe that we should be using, keep using or make a bigger use of macro-prudential tools. For instance, if there is instability or rising, big-time inflation in the residential market, then, well, we could endorse down payment rules on housing purchases, forcing people, for instance, to have a bigger down payment when they try to buy an apartment or a house. And then there are what I call more progressive mandates, which could be given to the Bank of Canada. We could have, well, still the 2% inflation target, but with flexible inflation targeting. And in fact, in the USA in September 2020, the president of the Fed there declared that the Fed was now on a flexible inflation targeting mode, meaning that, under some circumstances, if there has been a long period of high unemployment and low rates of capacity utilization, then the Fed could let the inflation rate go much above 2% for a while. Many of us, in particular with my colleague Mario Saccareccia, we have been arguing that the Bank of Canada should have a dual mandate, meaning inflation target and full employment. And this has been endorsed, in fact, by the Bank of New Zealand, the Central Bank of New Zealand in 2018. We believe that to some extent, in any case, this is how the Bank of Canada has been behaving since 2008. And so we believe that the bank has paid a lot of attention to employment. And despite its mandate saying that inflation is the only mandate. So we think the bank should say it explicitly. And then there are others who believe that the inflation target should be raised, say, to 4%. On the other hand, there are people who argue for more conservative mandates. Some argue, well, we should take profit from the fact that the inflation rate right now is below 2% to decrease the inflation target. There are people who believe that we should have a nominal GDP target. I believe that this is a new form of monetarism. And there are people who, on the basis of their new Keynesian models, believe that it would be optimal to have price level target. As I said, myself and some of my colleagues believe that the best would be a dual mandate, but the more likely situation will be the status quo. Well, this is it. Thank you for giving me the opportunity to present my ideas to you.
Well, thank you very much, Professor Lavoie, for this very interesting presentation. I would like to ask you regarding the role of monetary and fiscal policy during this pandemic. You have just shown with the Canadian experience that central banks, by providing liquidity, have ensured financial stability, but that the recovery will be mostly about fiscal policy. But at the same time, as you just said, the saving rate has raised during these months due to the uncertainty about the future and also the remaining restrictions to mobility and the capacity of households to spend money. So my question would be if there is some sort of policy that has not been discussed and that should be implemented in this transition until we finally overcome the pandemic and we reestablish more normal saving rates in the economy.
Well, I think what this shows is that fiscal transfers to households is insufficient in the sense that there's more income, but there isn't more economic activity. So what this means from my point of view is that it means that there has to be investment spending by either the provincial government or the federal government. And so there has to be we can take the opportunity to construct residences for poor people. This kind of, or we can invest in infrastructure. I mean, a lot of our roads are in very bad condition because in Canada we have so much snow, cold, and so the roads are very much destroyed by these changes in temperature. And so there's a lot that can be done with respect to infrastructure, especially those roads, and with respect to social housing. So I believe this is what now should be done. I mean, the fiscal transfers have helped the people who lost their jobs, but it is not helping that much with respect to economic activity.
Okay. Hello, Professor Lavoie. Thank you very much for your very interesting presentation. You have just shown that this crisis somehow challenges Keynesian views in the sense that fiscal policy, which might be the solution to the crisis, is not working or properly working as expected because of the increase in saving rates. So what this seems to suggest is that there are constraints or new constraints that should be considered when drawing some policy prescriptions. My question is that once we leave the developed so-called world and we move to peripheral economies that additionally to the problems you have just mentioned face balance of payment crisis and so on, there are some additional considerations, additional constraints that should be taken into account. when suggesting policy prescriptions, even from a demand side view?
You're quite right. The COVID-19 crisis is much harder to interpret and to understand than previous crises, because as you said, it's not only a demand side crisis, it's also a supply side crisis, in the sense that it's, some people would like to consume, some people would like to purchase some goods, but they are not available just because all these firms had to close down for a month or more than that. And therefore, even when the demand is there, sometimes the supply is not there. I have in mind in particular, the wood being used for construction is very hard to find right now in Canada, where we have so much forestry. I would qualify what you just said. You said that Keynesian policies are not working. I would say, well, transfer payment policies are not working as well as we would have hoped for, but there is still this possibility for the government to create economic activity directly through those infrastructure investments. With respect to emerging countries, the additional challenges of emerging countries, I know there are many additional constraints, but I must say I am rather reluctant to say anything about them, because it seems to me that I am best equipped to discuss the problems of developed countries such as Canada, and I can provide theories that perhaps are valid both for developed countries and emerging countries. But it seems to me that those who are best equipped to discuss the implications of these theories for emerging countries are economists who live in emerging countries. So I would rather not directly respond to your question. I'm sorry.
Okay. To finish, Professor Lavoie, let me ask you something that we will be asking to different scholars throughout this conference. Do you think this crisis will have some impact in economic thinking and policy making, or we will go back to the old normality?
Yes, this is a very interesting question, one that we discussed quite a lot after 2008. Well, I'll give you a wishy-washy answer, in the sense that there has been some change in theoretical thinking. We have seen that a number of mainstream economists have said things that one would have never expected. Before the 2008 global financial crisis. With COVID, if I can only give the example of modern monetary theory, it's clear that many governments in many countries have sort of shown that, yes, it is possible for all these countries to have large deficits, to have bigger public debt without the interest rates moving up. So we have again repeated what happened in 2008, at least for some countries, if we exclude the countries which are part of the Eurozone. So yeah, I'll give you a kind of ambiguous answer here. I think some of mainstream theory is kind of adapting to what has occurred with the crisis. But overall, I fear that not that much will be changed.
Okay. Well, Professor Lavoie, thank you very much again for participating in our conference.
Well, it was my pleasure to have this opportunity again to talk with you. It's the third time I'm part of this Jornadas organized by the Central Bank of Argentina. So I'm very honored to have been invited once again.
Okay. Bye-bye.